Okay, so good morning, everyone. Welcome to today's macro snapshot. We are Monday, February the 12th, 2024. Okay, guys, just want to have a look at a couple of things. Let's look at a few markets and see what's going on. Obviously, last week on Friday we had the CPI revisions, which it was revised down a little bit for December, but up a tiny little bit for I think October and November. But all in all, this is something which should not have been worrying the Fed. And if we look back to Waller's speech, who's an influential member of the FOMC, Waller said, a few months ago that he had been quite shocked, and Powell also said by the previous year's CPI revisions. And so that's something they were looking at. And so for me, it's kind of curious that on Friday, the bonds didn't have more of a rally. And let's just have a look and see what's going on with the bonds and just with the Fed in general, because of course, this week, what we do have is the CPI coming in tomorrow. We'll talk about that a little bit later on. So that's going to be very, very important to look at the next positioning for bonds and potentially the equity market. So if we just look at bonds, if we look at the front end of the curve, what we can see is that in anticipation of the beginning of a cutting cycle, if we look sort of in this sort of November, December kind of area, that the price of the ZT, this is the one, the dailies on the ZT went up. But what we've seen since then is that the front end of the curve has come off quite a bit. Here's the ZT, and then you see the 5-year has come off a little bit as well. Not so much out at the back end. And so what we've seen as well is a little bit of sort of a bear flattening, not huge, just sort of a gentle bear flattening. So let's just review a little bit and see sort of what's been happening. And I think what I'm trying to understand is the market now believing the Fed will not cut, will cut less and later, or possibly what's going on is that there's a little bit of a reorientation around the question of growth. So what do I mean by that? Let's just go back to the December summary of economic projections. So what we've got here is what the Fed's last sort of summary of economic projections. Keep in mind, we didn't have those at the last meeting, but we will have them in the upcoming March meeting. And what's kind of interesting here is that you guys will remember that the Fed said that, they'd be cutting equivalent of 3 times, so 75 basis points for 2024. And then for next year, 2025, that would go from 4.6 down to 3.6. That's the median, which is 100. So all in all, 75 basis points of cuts this year, 100 basis points of cuts next year in 2025. And what we've seen over the last few months is that the market has front run that a little bit in maybe even excessively dovishly. And so possibly all that we're seeing at the moment is the market coming back towards the Fed a little bit and pricing out a little bit of that excessive dovishness. It doesn't necessarily mean the market thinks the Fed will not cut anymore. And if we actually go back and have a look at where the market is at the moment, we can see here, this is the US. We can see that, the market's saying nothing for March, okay. But by the end of the year, so this is for the mid-December, we can see 4.5 cuts are priced in, or about 114 basis points. So the thing is, that's still more dovish than the Fed. The Fed is saying, we're going to cut 3 times, 75 basis points. And the market is saying, well, we think actually a little bit more than that. And some of that is sort of statistical probability distribution. So at this point, nothing really, it's not that the market is disbelieving the Fed, it's just that maybe it's repricing the question of growth. And what do I mean by that? I mean that if we look back at the Fed's summary of economic projections, you can see here that if we look at the change in real GDP, that's actually at 1.4% and 1.8% in 2025. And if you look at the latest numbers from the GDP numbers, and also let's say something like the Atlanta's Fed GDP tracker, this number is getting up into the late 2s, maybe even 3s. What does that mean in simple English? It means that the economy maybe is performing better than the Fed had anticipated, that the GDP projections may need to be revised upwards. So the point here is that the question around growth, and we all know that we've had pretty strong labor market data and growth data recently, we possibly that just because of the Taylor rule, and the Taylor rule says that the Fed will adjust the Fed's funds rate based on growth and employment numbers, and it's almost like a mechanical kind of sort of reaction function. So here's the point. The point is that if the market believes that the Fed will revise upwards in March their GDP projections, could it be that one of these cuts for 2024 or maybe even two, but one of the cuts for 2024 may be removed at the next dot plot at the next SEP announcement in March. So instead of being 4.6, maybe that'll come down, 10, 15, 20 basis points to 4. It might go up a little bit to 4.7 or 4.8, something like that. And maybe that's what's happening when we go back and we see that the market has been, sort of pricing out just the number of cuts. So if we look here and we go, let's say we'll go to the number of cuts priced in, we'll just bring up a chart here. So this is the number of cuts for the entire year. You can see that if we go all the way back to January, the market was pricing in about 6.5 cuts. And now, about 5 or 6 weeks later, we see that it's only about 4.5 cuts. So almost a full 50 basis points has been taken out there. And that's kind of quite interesting because that's just going back towards the, more towards what the Fed is guiding. But I wonder if that's something to do with the market thinking that maybe growth is an issue. But when we start talking about growth, you have to say, well, okay, what would be the classic indicators of growth? And this is where we can get back and look at a couple of markets here. And one thing I would say is that, like, ordinarily that would put sort of upward pressure on the long-term yields. And if we look at, let's say, like the US 30-year, we can see that, to a certain degree that has gone up a bit, but not enormously. But we'd expect things like, for example, copper to do well. And as you guys can see, copper has been falling off, falling pretty seriously for the last sort of, few weeks or so. We could look at, let's say, in the energy space, we could see that oil, is pushing up a little bit at the moment, but essentially is pretty flat at the moment. Not exactly the case with heating oil is strong and distillates are strong, and gasoline is relatively strong if you look at gasoline. So in the energy complex, nat gas and crude oil are very, very weak. But if we look at some of the individual products, they're relatively strong. So energy is sort of, it's mixed question about growth. But then we can look across it, just like a general commodities kind of space. And we can see that something like DBC has been, that tracks about 55, 60% oil. DBC is, relatively weak. If you look at JP, which is a broad commodity index, that's trading, fairly heavily as well. Look at GSG. A lot of these are relatively heavy. So the question is, it's sending mixed signals. The bond market seems to be telling us that maybe, the bond market is worried about the Fed maybe taking out one sort of interest rate cut at the next meeting, and is worried about that growth is too strong. But on the other hand, if you look at classical growth indicators, they're not screaming a lot of growth. So it's a tricky one, and maybe just the simple thing is just to say that we shouldn't sort of overthink it, to use that cliched expression, and just say that the equities all-time highs. We see that the Qs are doing very, very well. We see that the Magnificent Seven is most of that. And maybe very simply, the market is saying, hey, we've got a little bit ahead of ourselves in terms of the bond pricing. The general or real economy is doing quite well. So yes, there's a little bit more growth, but interest rates are not going anywhere sort of crazy. So, the equity market can continue to perform well. Now, just talking about the equity market, guys, a lot of people saying, it's obviously a little bit oversold if you look at the RSI. Where could this finish? I mean, there's different ways of measuring this. I mean, some people like sort of Fibonacci extensions. You can do a very, very long-term one. I mean, we can throw this on just for the sake of looking at it. And as you can see, if you go all the way back to the October kind of sort of pivot low here, you can see that we are getting towards some of those sort of Fibonacci extension levels. We've reached one here, the 786, 5028. That's kind of interesting, but potentially it could push a little bit higher. On the other hand, if we sort of, shorten some of those up, we can see that that's overextended. On the other hand, we could, let's say, for example, do a very short-term one, something like this, and you can see we have a little bit more to go. So it's difficult just to try and project this up because we're at highs, but certainly we're probably, maybe another 50 basis points or 1% or 1.5%, it might be time to, to start thinking about lightening up for those of you who are long or have a sort of a long bias. But at this point, earnings have been, I think we've had about 350 or so of the 500 companies in the S&P. They've generally been doing pretty well. Of course, we have the big one. We have Nvidia still to come, and maybe if that's going to be a sort of a sell the news, buy the rumor kind of situation, could that represent some kind of local top. We'll have to see. But so far, the semiconductors have been doing very well. Obviously, tech has been outperforming bonds, and that's just continuing. That's where things are going. But just getting back to the bonds, just want to have a quick look and just look at a couple of other sort of charts and metrics here for you. If we look here, we can see, sorry guys, just got a lot of stuff here on the thing. Let's have a look here. So again, just want to see what's about. If we go back, let's say 2 months or so, we're now on the 12th of February. So if we go back, let's say something like beginning of, I don't know, like the beginning of December, for example, you can see that just like an incredible change, that we had a lot more sort of cuts priced in. And even at that point, they were thinking there were going to be, you know, 3 cuts priced in by March. So just to say that we've had a very, I just want to bring this one back. We've had a very dovish repricing of everything. And you can see that if you look at something like in some of the SOFR contracts here, if we look at, let's say, the spread between the March, this is the H4, so March 24 and December 24, you can see that if we go all the way back, I mean, let's see how far back we want to go. This is a 60-minute chart. So, but let's say, for example, we go back to like a local, even as, you know, back in January, the market for that 9-month period between March and December was pricing in about 135 basis points of cuts. We're now down to 107. So that's about, what's that about? That's a full cut has been priced out, about 28 basis points or so. And so it's clear to me that what the market is saying is, you know, the Fed will be cutting, probably not as much as we had anticipated. So we need just to price that out a little bit. There is maybe a little bit of nerves that around the March meeting, the SEP, the Summary of Economic Projections, who knows, could the Fed revise the dot plot upwards in terms of the median dot? And that would be a bit of a shock, but it looks to me as though the market is maybe just building that in a little bit. Now, in terms of what we have today, we do have at 11 o'clock, the New York Fed has the 1-year inflation expectations. That could be quite interesting just to see that things want to be on track. And again, what all the Fed members have been talking about, as we know, is looking for more confidence. And they want to, first of all, they had more confidence from the last reading revisions on Friday. They have the 1-year inflation outlook today. Tomorrow, obviously, we have CPI. Then at the end of the week, we have PPI and the University of Michigan. And retail sales. So there's a lot of data coming in this week, which could give the Fed, in theory, more confidence. So then the question is, well, you know, could the bond market sort of have a little bit of a bounce? It's possible. I mean, we've seen that the front end of the curve has been beaten down quite severely over the last few weeks. Let's say, for example, we get a lower that we have a, you know, a sort of a coolish number on the 1-year inflation today at 11 o'clock. We have a lower than expected CPI tomorrow. That's confirmed by a lower than expected PPI. The Michigan expectations for inflation are sort of soft. I mean, who knows? Maybe that could be a nice sort of bounce in the front end of the curve, which could give further support to equities. We'll get a little bit more sort of Fed speak this week. Just have to keep an eye on here. This is the 12th today. So we have Bowman, Barkin, Kashkari. A lot of these people have already spoken. The one which I will be looking out for, guys, is 1:15 on, what day is that? That's on Thursday. We have Waller. I mean, it says he's giving remarks on the dollar's international role. I guess for FX, that could be interesting. But Waller's the one who seems to have the ear of Powell and seems to be theoretically and sort of intellectually quite influential on the FOMC. So I'll definitely be listening out for that. In terms of just other stuff on the markets, pretty quiet morning so far. As I say, we don't have a huge amount of data. Equities obviously at all-time highs. I mean, the issue there is to start looking for some kind of topping formation. But as people like to say, a bottom often the bottom is kind of like a moment and it rebounds, whereas the top, you know, is a kind of a process which often takes multi-weeks, even months to kind of form. So no implication at the moment that this will fall. There's zero technical damage done at this moment. What I would say, it's interesting to look at the equal weight. If we look at the RSP, which is the equal weight, doing relatively well. Obviously not as much as the Magnificent Seven or maybe Magnificent Six if we exclude Tesla, but still, you know, the breadth has come back a little bit. And if we look at something like the Russell, Even the Russell is hanging in there relatively well. We saw a lot of divergence if we go back to September, October. We saw the Russell was really, really strongly underperforming the NASDAQ and the SPY, but the Russell doing relatively well. In terms of other markets, as I said, I've talked a little bit about the bonds. One thing which is interesting is that if we look at over in Europe, what's going on there, just put up a chart here maybe for the Bund, just while we're looking at that. There's the 1 year on the Bund, which has also come off. We're starting to see quite a divergence of opinion within the governing council of the ECB. We had Panetta of Italy saying that rate cuts should be happening sooner rather than later. Of course, we have people like Nagel and the Hawks and Schnabel more on the sort of Germanophone part of the table, much more hawkish. So there does seem to be a little bit of internal divisions within the ECB. At this point, the ECB is still priced to be, fairly dovish and be cutting. I guess we'll just keep an eye on that. Other things to be looking at here, guys, we're just looking at oil. As I say, rejected here at the fib. This is CL1. You can see here that we did have this nice little bounce, but just at the fib zone here, the 61.8, 76.32 rejection. Again, oil is just very much cut, sort of chopping around between the two narratives of supply. The Saudis and other OPEC members are trying to limit supply. The Saudis currently have about 3 million barrels of excess capacity, which they're not using. On the other hand, you have the whole issue of is the global economy, or especially like China and Europe, maybe slowing down a little bit, whereas the US, it seems to be doing quite well. So a little bit of confusion there. I suppose we just look technically, personally, looking at oil here, I suppose the issue here, it needs to stay within this sort of fib box. And probably really what we'd want to see is maybe just the very, very short-term fib, which I'll bring up. Let's say I'll bring it up. Just give me a second here, guys. Let's say from here to there, you would want to see any retracement being bought. So again, at this point, you would probably want to see it, just being bought on, maybe the 38 or the 50% fib around about here. So I think that level there, just over $74, 74.40 looks fairly key. If it goes below this fib here, then we might, do a double retest, and even at that point, then you start to open yourself up for all kinds of tests. But at this point, it is trying to grind high. We do see a little bit of a trend line here, which is probably something quite interesting to keep an eye on. Bit of a trend line there. So, that would be sort of the really the line in the sand. As I said before, what else? The only other thing I'd like to talk about quickly, just keep in mind Australia versus New Zealand dollar. The Australian dollar has sold off pretty strongly against the New Zealand dollar over the last week or so. And that's just because a very influential commentator in New Zealand thought that the New Zealand Central Bank, or the Reserve Bank of New Zealand, may actually have to hike again, or want to hike again, just because of inflation metrics are not going soft, not going south in any shape or form. And concurrently with those kind of comments and data, we had out of the new governor of the Reserve Bank of Australia, Michelle Bone, no, sorry, that's the Fed. I'll have to Bullock. Bullock. Yeah, she said at the same time that that inflation had come down quite strongly in Australia. So there's a bit of a divergence there. So a little bit of interesting opportunity there for a spread trade, shorting the Aussie versus long the Kiwi. And just talking about that, we have again on Thursday coming up just after Waller at 1:40, we have the governor of the Reserve Bank of New Zealand, ORR, or speaking, and that's just going to be interesting to see whether he doubles down and confirms that the Reserve Bank of New Zealand is particularly worried about inflation, and if that's the case, that could lead to a little bit more pain versus the Aussie dollar, especially versus the New Zealand dollar. And actually, the New Zealand dollar has been doing relatively well just while on that versus the US as well, sort of hanging in there. Okay, guys, I might leave it there. Not a huge amount going on today, but as I say, just trying to get a bit of a zoom out and have a look and look at some of these bonds and what the Fed might be thinking, and more importantly, what the market might be thinking about growth rates. Okay, so we'll leave it there. I might try and have a look later today at the CPI, do a CPI preview or something like that. Thanks, guys. Have a great day, and we shall be talking soon. Thank you.